Gold has been one of the safest investments for centuries. Whenever there's uncertainty, people buy gold. Whenever inflation rises, people buy gold. Whenever markets crash, people buy gold. So why are gold and silver prices suddenly falling? Has something changed in the global economy? Should investors be worried? Or is this actually one of the biggest buying opportunities we've seen in months? In today's video, we'll break down exactly why gold and silver prices are falling, what's really happening behind the scenes, what the world's biggest investors are doing, and most importantly, whether you should buy, sell, or simply wait. Make sure you watch until the end, because the final reason might completely change how you think about investing in precious metals. Over the past few weeks, both gold and silver have corrected after reaching historic highs. Many investors expected prices to continue climbing throughout the year. Instead, markets suddenly changed direction. Gold started falling. Silver dropped even faster. Social media immediately filled with headlines saying gold was crashing. But experienced investors know something important. A falling price doesn't always mean a bad investment. Sometimes, it simply means the market is taking a break after a huge rally. To understand what's happening, we need to understand how gold prices actually work. Many people think gold is only used for jewelry. That's actually only part of the story. Gold is also held by governments. Central banks own thousands of tons of gold. Investment funds buy billions of dollars worth of gold every year. Even ordinary investors purchase gold ETFs and digital gold. Because gold is considered a safe haven asset, its price depends more on global economic conditions than jewelry demand alone. That's why even if jewelry sales remain strong, prices can still fall if global investors start selling. The biggest reason behind the recent decline is the US dollar. Gold is priced internationally in US dollars. When the dollar becomes stronger, gold automatically becomes more expensive for buyers using other currencies. Imagine you're buying gold from Europe or India. If the US dollar rises, you'll need more of your local currency to buy the same amount of gold. As demand slows, prices begin falling. This relationship has existed for decades. A stronger dollar often means weaker gold prices. Gold has one major disadvantage. It doesn't generate income. It doesn't pay dividends. It doesn't pay interest. When interest rates are high, government bonds suddenly become much more attractive. Instead of buying gold, many investors move their money into bonds where they can earn guaranteed returns. This reduces demand for precious metals. The Federal Reserve has indicated that interest rates may stay elevated longer than investors previously expected. That single expectation has pushed many investors to sell gold. Here's something new investors often forget. Markets never move in one direction forever. Gold had already delivered impressive gains. When prices reach record highs, professional investors lock in profits. Imagine buying gold months ago. If you're sitting on huge profits, selling some of your investment makes perfect sense. When millions of investors do this at the same time, prices naturally fall. This doesn't necessarily mean the long-term trend has changed. Silver behaves very differently from gold. Gold is mainly an investment asset. Silver is both an investment and an industrial metal. It's used in solar panels, electric vehicles, medical equipment, electronics, artificial intelligence hardware. Because silver depends on industrial demand, its price tends to move much more aggressively. During corrections, silver often falls faster than gold. But during bull markets, silver can also rise much faster. That's why investors call silver gold's more volatile cousin. Interestingly, while many retail investors are worried, several central banks around the world continue increasing their gold reserves. Why? Because gold acts as a long-term store of value. Countries buy gold to diversify away from paper currencies and strengthen their financial reserves. This long-term demand continues to support the gold market even during temporary corrections. So should you buy gold today? That depends on your investment goals. If you're looking for quick profits, Gold may continue to remain volatile, but if you're investing for the next 5 to 10 years, many investors view corrections as opportunities rather than reasons to panic. Instead of investing all your money at once, many experts prefer investing gradually over time. This reduces the risk of buying at temporary market peaks. Of course, no investment is guaranteed. Gold prices could fall further if the US dollar keeps strengthening, interest rates remain high, inflation continues slowing, global markets remain stable. That's why diversification remains one of the smartest investing strategies. Never invest all your money into a single asset. History shows that every major gold bull market has experienced corrections. If inflation rises again, if the Federal Reserve starts cutting rates, if geopolitical tensions increase, or if global investors once again rush towards safe haven assets, gold could potentially reach new record highs. No one knows exactly when, but markets move in cycles. Corrections are part of every long-term trend. Gold isn't falling because it has suddenly become a bad investment. It's falling because markets are adjusting to stronger economic data, a stronger US dollar, higher bond yields, and profit booking after a massive rally. Whether this becomes the buying opportunity of the year or the start of a larger correction will depend on upcoming economic data and central bank decisions. Now it's your turn. Do you think gold will recover? Would you buy gold at these levels? Or are you waiting for prices to fall even further? Let me know your opinion in the comments below. If you found this video helpful, don't forget to like, subscribe, and turn on notifications for more videos on investing, personal finance, and the stock market. Thanks for watching, and I'll see you in the next video.